This is Trader's Workshop with Adam H. Grimes. Hello, welcome to episode 13 of Trader's Workshop, Day Trading to Swing Trading, What I Had to Relearn. I'm your host, Adam Grimes. You can find more of my work at adamhgrimes.com, and you can follow me on Twitter at adamhgrimes. So many of you know my trading history, but just in case you don't, really quick outline. I started to try to learn to trade as a swing trader in futures. I was horrifically undercapitalized. I didn't know what I was doing on practically every level, really, but certainly leverage. And after a few false starts, the first success I had, which I think was partially due to dumb luck, just right market at the right time, but I had success very short-term trading currency futures. Fast forward that a few years, and I transitioned to short-term trading S&P futures, and I don't mean to trivialize that. That was a major transition. But I realized at one point that all of the success that I had had was as a day trader, a very, very short-term trader. I would do, day trading can mean different things to different people, but a very active day, I might have done 15 trades, and probably an average day would have been 4 to 6. So not, certainly I wasn't scalping, but very active. And I began to experiment a little bit more with swing trading, and I discovered I really liked it. I found, for one thing, that I could make a lot of money and put in a lot less time. And that's not laziness, it's really a matter of efficiency. I began to wonder, was there a way that I could continue to take money out of the market and not be staring at every tick while the market was open? And a few other experiences, including an MBA, and I was transitioning to trading stocks explicitly outside of a swing trading outside of a day trading perspective. In fact, the situation I found myself in, we were basically not allowed to day trade, so I was forced to swing trade. And this was actually was kind of interesting, because one of the big things that I had to unlearn was a bearish perspective. We'll talk about that in a moment. However, the time that I was making this transition was 2008, 2009. Which for those few of you who don't know, that was a very good time to be shorting stocks. So I actually had the experience for a few years of doing what would eventually, and over the long haul, definitely turn out to be the wrong thing to do, but it was validated by the market and validated by my P&L. So that's where I came from. And the points that I want to go through here today, here's what I've found to be very different in a swing trading context compared to a day trading context. First of all, bearish bias. We'll hit each of these in detail. The importance of understanding and the quality of action in related markets. Tracking setups, stalking entries, patience in general, both patience for the entry and patience for taking profits. The importance of position sizing, which is something that's usually quite simple for a very short-term trader, much harder for a swing trading perspective, and then an entirely new set of emotional skills related to all of this. That's a lot. Let's jump in. So most stock traders, and certainly most stock index traders, at least that I'm familiar with, tend to have a bearish bias. And you might ask yourself why. I think we have the sensation, at least, it is a little bit difficult to verify from a quantitative perspective, but people will say things like the market goes down a lot faster, the market goes down in a different way, with a more directional quality than it goes up, and that basically, even if you're in an advancing bull market, now outside of, say, pre-dot-com environment in which stock traders were doing nothing but buying and watching stocks go up. I think that particular environment was a little bit of an aberration. But outside of those rare moments where near the tail end of a cycle where stocks do just go up, most active traders focus heavily on the short side. Maybe another reason for that is because most traders are naturally contrarian. And we like the idea of fighting everybody else. We like the idea of swimming against the stream. And there's quite a good deal of self-validation that comes when you can look at a market that has gone up, 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 and known that you were short in the cracks and you actually made money. It's not easy to do. It takes considerable skill to do that. But one of the major shifts that I needed to make in my thinking was on longer term perspectives. Again, we can find cases where this is not true for a few years, but over the space of several years, stocks do go up on average. And this is true however we slice and dice the historical record for the complete history of equity markets. Stocks on average go up, and not inconsiderably. The baseline drift in stocks, depending how you adjust for company size, let's just call it 7% a year. Might be less, might be more, depending on the risk you're taking, but that is a pretty significant vig to overcome. If you're going to be short, if you're short and you're good and you make 7% on the short side, what you have actually done is, think theoretically for a moment, what you've actually done is overcome that baseline drift, so you end up with no money. You break even, and you see what I'm saying? The index drifts up. You find a way to be short enough to overcome that drift. You were correct. You have a trading edge, but you still have not put money in your pocket. And I'll tell you where you will begin to realize this in vivid detail is when you start doing quantitative testing, and you'll find many short setups that do exactly that. They are underneath the baseline drift enough that they are statistically significant, but you might still lose money on them. That's kind of a head scratcher if you aren't used to thinking like that. So really reorienting my thinking for swing trades in stocks, for intermediate trades, for intermediate term trades too, to focus on the long side, to have a different mindset toward my shorts, which is that they deserve a little bit less of the benefit of the doubt, that they need to prove themselves very quickly, that I'm going to manage them a little bit differently. And I say this with full awareness that this is late 2018, and there almost certainly will be a time within the next 5 or 10 years where, if you're listening to this, you're going to be in the middle of a huge bear market. Or you're going to be somewhere at the end of a bear market and stocks have gone down for 3 years. So you might be saying, well, what's this guy saying? But I'm looking over the course of a career spanning decades. And another thing about the short bias is, do you ever wonder why people have so much trouble going from one asset class to another? I think there are actually a lot of reasons, but this is one. If you are, for instance, a short-term index trader in stocks, or let's just say a short-term stock trader, you probably, again, focus heavily on the short side. Now, if you go to gold, if you go to crude oil, it's not quite the same thing. And in fact, if you go to currencies, what does it even mean to be short? People don't think about that right away, right? But if you're a stock trader, what does it mean to be long the euro? Well, what it actually means is you're long the euro and you're short the US dollar. So you're always long something and short something else. And that's not immediately clear to people who start trading currency futures, because they're pairs against the dollar, but most currency traders are pretty comfortable with that. So that was one thing that I had to learn, unlearn, relearn, and then kind of package in the right way, and I think it's very important. Number two, understanding action in related markets. As a day trader, you'll do this, but Honestly, looking back at a lot of what I was doing and what a lot of day traders do, I think it's probably a little bit silly. I think I'm not completely sure that I thought I was doing it at the time, but if I was watching the S&P futures, the Dow futures, and the Nasdaq futures, was there really much information in inflections at turning points where indexes confirmed or led? I kind of don't think so. I think when I was doing that, I probably did not understand, and it's not a simple analytical question, but I didn't understand how to separate out the noise. However, when you become a swing trader, the way that markets evolve on a day-to-day or a week-to-week basis is quite different. Yeah, at least my perception is. And again, these are things that may be a little bit hard to quantify, but this episode is being done because a lot of people ask me how to make the transition one way or the other. And I'm giving you my answer, which was day trading to swing trading, but you may be a swing trader and be looking back at day trading. You want to go the other way. And I think what you would find then is that a lot of the complexities that you must be aware of as a swing trader, those can probably be streamlined to a large degree, and you can probably focus on the simplicity of your technical setup if you're a short-term trader. Number 3, tracking setups. Actually, let's just call number 3 patience, okay? So if you are a short-term day trader, short-term / day trader, and let's say you're going to make on a quiet day 2 or 3 trades a day. Average day, you're going to make half a dozen trades a day. So for you, patience might mean you don't do anything this hour. You wait until the next 5-minute bar. When I became a swing trader, all of a sudden I discovered I did not understand the definition of patience. The definition of patience is looking at some stupid range in a market that extends 2.5 weeks, and you're ready any day to take a position long or short if it goes past your breakout point. And if nothing happens today, you don't do anything. And it's also knowing that maybe you have a trading book where, by trading book I just mean all of the markets you trade. Maybe your universe is 20 markets, and patience might mean that you'll go through several points throughout the year. Well, you will have many days where you have no positions on at all, and still you do the homework, still you track the entries. That is a difficult thing. And you also learn that the cost of breaking that patience, or the cost of breaking that discipline of trade entry, is a little bit more serious. If you're a day trader, you can get in, you got in too soon, it was stupid, you just get out. It costs you a commission. Maybe it costs you a few ticks. You do the same thing as a swing trader, and it costs you, if you're sloppy with it, maybe you're down 0.3, 0.4 R. Now, it's not the end of the world, meaning that you lost 30, 40% of your risk on the trade. It's not the end of the world, but you can't do that very many times before you start to hurt your bottom line. And the cost is considerably more significant. And probably the biggest, if I had to limit this podcast to 2.5 minutes, I could tell you the biggest thing that I learned was the importance of patience with regards to taking profits. In other words, we get into a trade and you set a profit target, and you're not going to take your profit, your partial profit, or maybe your whole profit, until that profit target is hit. There is a tremendous tendency, and I saw it in myself over and over and over, and I see it in traders that I work with. There is a tremendously powerful psychology that almost forces traders to take profits early. And by the way, this is validated with some of these stupid trading sayings, and sorry to be judgmental, but I will be, like you can't go broke taking profits. I already said in this podcast series, you absolutely could, and I did it. I blew out an account over the course of months, taking very consistent profits. there's this green is good. There are all of these sayings about that, but really what is good is disciplined entries, disciplined exits, and the proper probabilistic relationship between the two. And if you are getting into trades, risking a certain amount, and then the first time the trade moves a little bit in your favor, getting out of the trade or out of some of the trade, that I think it's very difficult to be profitable like that. And I suspect, probably not in all cases, but I can tell you, I do now understand. It was a strange thing for me. I would have no trouble taking a disciplined loss. I would have no trouble waiting hours and hours and hours for a setup. I'd have no trouble on a crappy trading day not taking any trades at all. I thought I had great trading discipline. But yet, what I would find was there was this incredibly powerful temptation, almost a force, that when I got into a trade, as soon as it was a little bit profitable, I really, 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 really wanted to lock it in. And it would be such an odd thing because let's say you're risking, let's just make up a number, let's say you're risking 5 points on a trade and it goes 2 or 3 points against you. No emotion whatsoever. It comes back to break even. Oh, you're a little bit happy, but really no emotion whatsoever. And then all of a sudden, the stupid thing goes half a point in your favor, and you're panicking to hit the button to get out, when really you were planning on taking a 5-point profit. I'm just making up numbers. But that I saw repeated over and over and over in myself. And what I came to understand was that this was a manifestation of the need to be right. Because even if I do a set of trades and I'm not profitable in that set of trades because I bailed on some of my early profit targets, and even if I had stayed with those and eventually they would have hit my profit targets and I would have had a nice profit, if I torpedoed that and lost money by getting out early, I still had the validation of being right on that trade, on those trades. And I would also have the experience where a trade goes a little bit profitable and I get out and then it goes back against me and would have hit my stop. Wow, now I'm really a genius because that was a losing trade, but I'm smart enough. I actually made money on a losing trade. And it kind of becomes this absurd feedback loop that is very hard to break, because if you don't see that sitting at the center of this is that overwhelming need to be right, and what that looks like and feels like. You think as a trader you can let go of it, but what it's actually doing is popping up in all kinds of strange ways. And until you understand that, until you understand what's going on in your head, it's really hard to overcome. Once you do, so you may say, okay, Adam, how did you fix it? Once I understood how important it was, and that was one reason it was such a struggle. I didn't understand how important it was. But once I did, then it was relatively easy. I'm not going to say simple, but it was relatively easy to just say, okay, you've got a choice. If you want to be a trader, you have to do this right. And if you can't force yourself to do this right, you can't be a trader. So what are you going to do? And it was that kind of very, I want to say almost aggressive, tough love, call it what you will, almost like drill sergeant kind of rigor with yourself, that if you can't do this, then you're going to be out of business. So you get to make that decision. That worked for me. Wouldn't work for everybody, but I suspect this is one of the dirty little secrets that people don't talk about enough, that many traders struggle with this and they don't even know they're struggling with this. So take a look at your results and ask yourself, could this be a problem? Position sizing, we don't really need to belabor the point here, but usually as a short-term trader, you will trade a fixed position size, or you might have a very simple table where your different setups, maybe you're risking different amounts. If you trade stocks, then you may need to do some calculations, or a lot of short-term stock traders just trade a fixed share size. You're in and out 5,000, 10,000 shares, whatever. As a position trader, a swing trader, then you need to really think about achieving that consistency that I think is only possible if your risks are consistent. Now, yes, there's a degree of granularity, and depending on how big your account is and what markets you trade, if you trade futures and you don't have a gigantic account, then let's say you wanted to target 1% of your account, well, let's just say 2% of your account per trade, meaning that if you're wrong, you're going to lose 2% of your account. You are not going to be able to get that number to be 2.00. No. Maybe 1.8, maybe 2.13 or something sometimes. But as much as possible, you try to come in around that 2.00. It's not 4. It's not 0.5. It's somewhere as close to that as you can get with reasonable granularity. And if you trade stocks, if you trade shares, if you trade currencies, then you really should be able to get pretty close. But the importance of consistent position sizing and the mathematics behind it, it is not complex. I think you could explain it to a smart child pretty quickly. And I do think that this is something that I have seen as I've watched the dialogue with developing traders develop over the last decade. I think this is something that people have a much better grasp of than we did 10 years ago. I wrote about it in my book, and other people have written about it quite extensively. And I almost feel that it's a little bit redundant to talk about this at this point because a lot of people get it. And it's good. It's a key part. And I guess all of this kind of points toward the last point, which is you need a completely different set of emotional skills. And, I hinted at that. You've actually heard this in several ways here. The big one, of course, is the grit to hold on to your profit targets and to not take those dumb little profits just so you can say that you were right on the trade. I'm still talking to myself as you hear that. Also, I'll use that word grit again to deal with drawdown. Drawdown, and that's an entirely separate topic, really, really, really sucks. And when you're a day trader, you have some bad days, you probably have some bad weeks, and you may have some months that aren't great. But in general, you get pretty quick gratification. If you have a really bad day, next couple days will probably be pretty good, unless you do something stupid, hurt yourself. But if you trade like a reasonable human, your chances of having multiple bad days in a row are pretty slim. And if you're a position trader, it's quite different. Even if you're a consistent position trader, you will very likely have weeks, maybe even months out of a year where it just seems like you can't find a losing trade. You can't find a winning trade. And then, you have the other side too. You'll have times when it seems like you can't do anything wrong. And both of those environments are very dangerous. Both are misleading. When you feel that you can't find a winning trade, when you feel that you must actually, you ask this question, am I perhaps the dumbest person who has ever tried to trade? And if you haven't felt that, you probably haven't been trading very long. We all feel that. And of course, it's not true. In most cases, what it really is just the interaction of luck and how this creates some pretty significant streaks in our results. But living through those streaks day to day, going to bed at night when you don't have control over your positions, and I guess maybe that's actually another degree of emotional skill, another type of emotional skill. As a day trader, you're in control. And I like a lot of my friends that were on the floor. A pit trader is even more in control of his risk because he may be risking a single tick. It's a little bit hard to do as a screen trader, but this is one reason why people struggle so much I think one reason why people struggle when they go from the floor to the screen, and why so many of those traders who were superstars on the floor were unable to make the transition to the screen. In some cases, yes, they had what we might call artificial edges on the floor that do not translate to the screen. But in other cases, it's that you really have to take your hands off the wheel and just let the trade work. as a position trader, and that is a completely foreign concept. It's a wrong thing to do for a short-term trader. That understanding what that felt like, and understanding that most of my life would be lived with having risk on, but not having the ability to actively manage that risk. Think about that. Like, as a day trader, yeah, you have risk on, but the market's moving, and if you don't like it, you can click the button and get out. But if you're a position trader and you're fully loaded, meaning that you have on the maximum number of positions you can have on, you got to go to sleep at night knowing that some of the markets you trade are closed. Some of the markets will move while you're asleep. You're going to get up in the morning and find out what happened. And more often than not, you win the battle, but there's some bad surprises. And accepting that overall, the returns certainly justify it, and that these are the kinds of risks that we are paid to take. We are compensated for these risks appropriately, but it's a very different psychology. It's a very different set of emotional skills. And I had to kind of figure this out by, guess how? By making mistakes. Reading some books, talking to some traders, but honestly, my own mistakes, my own losses, my own errors were the best education I had. I'm hoping maybe I can shortcut that for you, and maybe you can learn from my mistakes. You don't have to make them all yourself. So I hope this podcast was interesting and useful. If you are listening to this in real time, I will tell you that I'm going to be traveling a little bit over the next couple weeks. So I have selected a handful of podcasts from the first podcast series that I'm going to recap, reissue those episodes and the new podcast series just for continuity. But I spent a lot of time. I went back through and looked at every episode I did, and these were the standouts. I may very well revisit those topics again in this series, but I wanted you to hear those, and I will be a little bit out of touch on social media over the next few weeks, but I'll be back. So that is all I have here. I will see you back later this week for another episode. I would ask you to do a couple things for me. First of all, wherever you found the podcast, subscribe, like, leave a review. I know that takes a few minutes, but it really helps me and it helps people find the podcast. So if you could do that, I would certainly appreciate it. Thank you very much. And last, tell your friends. Anybody you know who is learning to trade, whether they're complete beginner or somewhere further along the path, please tell them how to find the podcast. Tell them how to find my work at adamhgrimes.com, and I will certainly thank you. I'll be back with another episode very soon. Thank you very much.
Well, it's never hard